But we do think, in general, it's probably a topping process. Things are really expensive. We're about 21 times on the S&P right now as far as earnings multiple, and you normally don't start with a big bull market from that level. So I'm not saying you have to have a sell-off. I mean, if you had a tremendous amount of money come in from the fiscal side or something like that, it would change. But the way it stands right now, it looks as though we're pretty fully priced right now.
On this episode of the What the Finance podcast, I have the pleasure of welcoming back Ted Oakley for a third time. So he needs no introduction. So Ted, thanks so much for coming back on the podcast today.
Glad to be here, Anthony. Thanks.
No problem. I'm looking forward to the conversation. We've had a interesting first few months of the year. So I guess from your perspective, broad picture, what are you seeing in the markets?
Well, I mentioned this earlier today, but we wrote in the January comments that we put out early January that we thought the market would make a new high in the first quarter because you get this close and typically they'll push it into new highs. But we do think, in general, it's probably a topping process. Things are really expensive. We're about 21 times on the S&P right now as far as earnings multiple, and you normally don't start with a big bull market from that level. So I'm not saying you have to have a sell-off. I mean, if you had a tremendous amount of money come in from the fiscal side or something like that, it would change. But the way it stands right now, it looks as though we're pretty fully priced right now.
Yeah, I guess if we look at today, there's been quite a bit of news. So, corporate real estate, a few other factors have come online, higher inflation, I guess, wage growth. So it seems like there's quite a lot of negative news that's coming out. And as you said, we've had quite a run up the past few months.
Right. Well, you have. I mean, I don't think you would have had it necessarily, but the Fed came in October and basically said, hey, it's going to be okay. We're waving at you. Everything's going to be all right. And we're not going to raise rates anymore. And everybody took that to mean that we're going to lower rates real soon and we'll be back like we were 3 years ago. I doubt it, but that's what people thought, I think.
Do you think they made a mistake? Because, yeah, as you said, they were sort of very hawkish the whole year. And then that one interview or that one meeting where they were very dovish. And I think, as you said, there was this massive switch. People were thinking 6+ rate cuts in 2024. So do you think that was a mistake on his behalf?
Well, I have to tell you, Anthony, I think everything they do is a mistake almost. So this is just one more. I mean, if you look at the last 25 years, they're one of the part and parcel reason we're in this fix we're in today is the Fed. They left their knitting, which was not to necessarily make sure the stock market didn't go down. That was never one of the things was, assigned to them, but they took it on in the last 25 years. And unfortunately, it will cause eventually a lot of pain, I think.
Yeah, it seems like it. And as you said, I think they've sort of had to reverse what they said, come back a bit hawkish, and that's had a bit of a large impact on the market. I think, as I said, they were predicting 6 cuts. Now it's sort of down to 4. And now they're thinking potentially less, in line with what the Fed was saying. So maybe it was a bit of exuberance.
I have no idea. Whatever happened wouldn't surprise me, I have to say, but I just don't know where they're headed,
Yeah. So you said you think it looks quite toppy. So from your experience, what does a top normally look like, and why is it maybe comparative to previous years?
Well, usually a top, they look similar. You take the leading stocks, and some of those start to fall back. They're not as strong as they were of the very, very leading stocks. But it looks like they are because the ones that are leading keep on making these exorbitant new highs, and that pushes the markets up. And it looks like to the outsider that the S&P and the Dow have hit a new high, so things must be okay. But if you look at the Dow Jones, the Dow Jones Transportation Average, the Dow Jones Utility Average, see, they're not at new highs, and they're definitely important to the economy. And then also the NASDAQ, not the NASDAQ 100, but the NASDAQ has not hit a new high either. So it's a camouflage market, and it always happens at the high. And then you get to a high point, and then you start this volatility. You'll have these days that are, up 2%, down 2%, up 2%, down, but you don't make any big headway. And then one of these times, after volatility picks up, you'll see come in and all of a sudden we make some lower lows. And then all of a sudden it starts to implode on you a bit. And my guess it would be something like that. The only thing that would keep that is if you were to have, again, some big fiscal intervention from the government that pushed a lot of money back in and rates came down, and there'd be a lot of mistakes there, but it would certainly juice the market. I just don't think that'll happen this time around.
Yeah, I think it's hard to imagine the government injecting more fiscal support than what they're currently doing. So I think it's a record highs.
Yeah. I mean, if you think about it right now, okay, you have low unemployment. I mean, like 3.2. Well, if you come in and lower rates all of a sudden, and right now wages are up 5.5%, 6% for the year, you won't be able to hire anybody. Everybody wages will go up 10%. They'll just sort of rejuice the thing again. And I think that's the problem you have. They're at the point of rock and a hard place, I think, right now.
So what would be the decision that they should make? As you said, is it just remaining hawkish, keeping interest rates high? Do you think they should increase them even further?
I don't think they can do a lot right here. These numbers that just came out for January for CPI and PCE were higher than everybody expected. And if you look, that means probably can't do anything in March. We're right on March. If you have another month like that, then you probably can't do anything in May. And then you get into the summertime. I'll have to say I have no idea, but my guess, just a guess, is that if the numbers stay strong in February and then in March, that they may not lower it all this year because they probably couldn't. But gosh, it's anybody that is thinking that they're going to do this or that, I don't know where they get it because we certainly don't know. We just have to. We know what we know. Like I know what I can get in a 1-year Treasury and a 6-month Treasury. I know what I can get, guaranteed. Okay, but I don't know what the Fed's going to do.
Yeah, it's a good point. So you mentioned sort of at the start of the year, you were projecting that markets could go to all-time highs. So I guess if we look at the next 3 to 6 months, do you have any perspectives there, or is it sort of linked back to your thoughts of uncertainty?
Well, we're expensive right now, so if you think about it, you have to think about it. What happens now? If you think, like, if you look at 21 times forward earnings right now, you just don't start new bull markets there. I can show you a lot of these markets, and I think people have been fooled to an extent because if I bought the S&P 500 in the last week of December 2021, and I measured it today, which is a new high, just barely, a few points, then I still made more money on the 6-month Treasury or 3-month Treasury than I did in the market. And I just think people don't remember that. They don't really think like that. They think, oh my gosh, the markets have been hot as a pistol the last 4 months. That's true. But over a time span, a cycle, you haven't made any money really.
Yeah, as you said, there's been a lot of noise, but it's and it has gone sort of down and then back up, but it has hardly moved over the past few years.
You have to look at the whole thing. I mean, it's interesting I remember Bernanke and the Fed chairman back in 07 or early 08 was talking about the fact that they definitely had subprime. He thought it was totally under control. That was a major mistake. And then I see a week or two ago where Chairman Powell is on 60 Minutes, and really we think we've got commercial real estate under control. And I'm like, now there's a guy that hasn't been on the street in a while.
Yeah, but as you said, Bernanke was famous for making these. What was it? I think that was Gordon Brown, the end of the recession, and then 2008 came
Yeah.
along. So I guess they love making these overarching statements. But yeah, they are. So it's impossible to avoid. I think it will always come. Do you think there's a risk that maybe the whole of the drive up since 2020 has been a bull market? So we've had like quite a large drawdown in 2023 and 2022. Do you think that was maybe just a bull market drawdown during that period? Is that possible?
Well, I think it's part of the whole top. In other words, when you get to these points, let's face it, we had a 6-week bear market in 20. we had a 10-month bear market basically in 22. So you haven't really had what I call a true bear market, extended bear market, which is usually 18 months or so. Sometimes it'll go as high as 3 years. And so I don't think you really put people to the test yet. And I know for sure you haven't gotten a speculative nature out of this market. And we have more speculative activity today, I think, than we had even in late 21. And so, we'll see how it comes out, but everybody's in the market. Everybody, every pension plan, every person, every foreign fund, and they all own the same stocks. And so it makes you wonder what's going on. And then you pop open the Wall Street Journal today, and it says the teenagers are in the game. They're making a lot of money on these big 7 stocks. And so, when you're getting close, it's like Bernard Baruch said back in the 20s, when the shoeshine boy knows what's going on in the market, might be trouble ahead.
Yeah, and when your friends' kids are making lots of money, then that's another concern as well, I think.
Well, it's just that business is just not that easy. See, I mean, it's just not an easy game. And so ask any business person out here, woman or man, that runs a business, and they'll tell you that, hey, I got to fight this fight every day. And I think for people to think that I can show up and speculate for 6 months or a year or two, and it's easy to do, I think they'll learn a tough lesson from that. That's personal opinion. May not happen, but it usually does.
Yeah, definitely. So if we look at so would you say the last year has been a bull market, or would you say that's sort of just a connection to the previous? Yeah,
Oh, I don't think it was a bull market. No, I mean, bull market is when you move from, when you move into new high territory and you do it strong. A lot of volume, a lot of companies participating. All we did was make up what went down in 22. We didn't really do anything else. And the other side that people don't realize is if you look at any market low and you go all the way back to 75, 82, 2003, 2009, you look at these lows, when the market takes off, they don't give you just 1 or 2 or 3% like this one has just done. They give you big moves, and they happen day after day after day, and you don't have a chance to get in them. They just keep right on going. And that's a bull market. What we've seen here is a trading market, and it's been good for some people that trade it like that, but to us, that's what it is. It's not a new bull market.
Okay, that makes sense. And you mentioned how that business can be quite tough, and invest in business, but sort of any business as well. If we look at, Main Street has really been struggling while Wall Street has been massively benefiting. So why do you think there's been that disconnect? Is that just what happens during these exuberant periods, or is it something maybe new?
Well, it always happens at highs. I could take you through different highs, but I'll take you a few. In the early 80s, oil and gas was hot as a pistol. And every Canadian and U.S. oil stock that even went out and hit a small oil and gas well would just explode and go up. Everybody was in it. And of course, they lost so much money by the time you got out to 85 or 86. And the same thing happened, 97 to 2000. You had all of these people that I knew that quit working and said, hey, I'm just going to day trade now. I'm making so much money. And this is my new business, is day trading. And so I'm looking up by 2003 or 4, nobody was day trading. They took everybody to the woodshed. And so this will be the same. Generally, it'll work out the same. I mean, you'll have all these people now, they're doing, 0 day to exit to options, ODT options, and that kind of thing. And, it's a recent phenomenon, and those things typically won't last for the long term. They last for a while, by the way. So that's why people do it.
Yeah, for lots of years, potentially. So you'd say that has been driving the markets while the economy has still been struggling? Or do you think, because I guess last time we spoke, you were saying that, the consumer could start struggling, but it seems like they've been able to sort of keep their head above the water. Why do you think that was the case?
Well, they just kept on borrowing, Anthony. If you look at, the levels of debt have gone up, buy now, pay later has gone up, Delinquencies are up, auto delinquencies up. A lot of delinquencies are higher, and they just, they borrowed credit card money, and that works for a while too. I think they were used to having that extra money from all the COVID stimulus, and they're like, I'm not going to give this up. I like this lifestyle, and I'm just going to borrow money to make it happen. In the end, that doesn't work though, and it'll work for a while again. And then when you have a slower economy, they won't be doing that. They'll be trying to pay rent and buy groceries.
Yeah, good point. I did recently buy a computer which was 0% interest for sort of 4 years. So
See what I mean?
it's ridiculous. Like
Yeah.
these, and I'm sure the company will put that on their report and say, "Oh, look at all this money that we've made," even though they actually haven't even received it yet.
And you probably have a good bit of that of where they're recognizing revenue that they don't really have yet. But I don't know. I don't own those companies. If I did anything to those companies, I'd probably short them. But I don't. I'm not doing that either. But I just think that's not an area that we would like for a company we want to own for 10 years or something like that. But that's that's the times we're in, and that's what I see with people. They're speculating and like there's no tomorrow.
Yeah, definitely. And while you say the market is expensive, it does seem that it's been driven by these companies which are growing very quickly. So Nvidia, so I think it was like 60% earnings growth, and other companies like that. Even though they are probably overvalued, they are growing. Do you think this time could be different? They're making billions of dollars. They're growing at a fast rate, or do you think it always comes to the point where there's a wall and they can't continue to grow?
Well, they used to tell me that about Cisco in 2000, and it went from 82 to 8. So and I remember Sony in 1995 was the stock, everything you owned. And if you were anybody at all and you had to have everything was Sony headphones, Sony recorders, Sony Walkman, Sony CD player, and everybody was like, Sony will never go bad, and went from basically 155 to 10. These things have a life of their own a lot of times, and then they go away. And so most of the whatever growth you're expecting in the likes of Nvidia and that type of company is probably already in the stock. That doesn't mean it can't go higher, because speculation can really run long and hard, but it probably is in the stock at this point. And you have to think, well, what could I make over the next 10 years from this company? What would it do? And since everything is tied to AI, I mean, everything you open up now is AI. Well, AI is not going to always put groceries on the table. I'm not certain it wouldn't help a lot of things, but there's a lot of things it won't help as well. And I think we've gotten caught up in it.
Yeah, it does remind me of the blockchain fad in 2019, 2020, and around then,
Well,
where everyone was trying to
yeah,
implement blockchain.
the same thing with the internet. I mean, I've listed, and I've got a list of these 350 companies that had .com on the end. And there's a great book out there called .con, C-O-N, that lists all of the companies in that period that didn't make it. These were public companies. There's a lot of them. And anytime you threw .com or internet behind your name, they all went up, just like they are now. Everybody, when you can't get your stock up now, you start talking about AI, so people will buy it. And when you may or may not know anything about AI, I certainly think it's going to be something that transforms a lot of things, but it's not going to transform everything.
Yeah, I work for a oil company, and we had the standard talk about AI in the CEO speech, which is I thought was quite funny. So you mentioned, yeah, what would you have to see to maybe change your perspective on uncertainty and think that this bull market could continue? Is there anything?
Well, we run a lot of screens, and I couldn't really show it to you, but we run a lot of screens on a few hundred stocks, and we know when they get in the zone where we want to buy them. In other words, we're looking at what we think they can make the next 5 or 6 years. We discount that back for inflation, and then we try to buy lower than that. None of those are really. There's a few, not a lot though, that are in that zone where we would buy. It's nothing to do with the market. It's just that if you don't buy it's like real estate. You make your money when you buy it. not, that's when you make your money. You got to buy right. And that's the way we are with stocks. And right now, there's just not many of those stocks that really hit the screens for us. By the way, we own a little bit left over, not a lot, but we own a little bit left over of Apple, Amazon, and Google, and Microsoft, but small pieces that we've owned those for many years, but we don't own a whole lot of them now because we keep selling them as they go to new highs, and we're almost out of a lot of that stuff. But if you go to people today and say, I'll take Apple, for example, number one owned stock amongst professionals and individuals. If you go to an individual today and said, hey, I want you to sell your Apple or sell part of it, you might as well say, well, let me kidnap your kid for a year. I mean, it's like, we're never going to do that. And that's I've seen that before too, by the way. And I remember Intel in that same period, late 99, early 2000, and they just thought, man, you got to own that Intel. Well, after a while, you probably wish you didn't own it. And that's just the way these things go. I'm not laughing at it. That's just the marketplace. You have to buy things when they're priced right and not get caught up in outside noise on it.
Yeah, that's a great message. So you said you wouldn't own a lot of these, stocks that are at the moment. What would you own? What do you mentioned that you look at these companies, but yeah.
Well, we've just bought some energy companies in the last month. If you look, we bought EOG, we bought Williams companies, we bought Northern Oil and Gas. Then on the pipeline side, high cash flows, we bought Enterprise Products, MPLX, Energy Transfer. We've owned those for years. And those will pay you, 8.5 or 9% on a K1. It's better than real estate, in our opinion, right now anyway. And we like real estate, but it's better right now than that. And we bought some defensive stocks in the fourth quarter: McDonald's, Coca-Cola, Unilever, some companies like that. But we still have 50% in the 3-month Treasury. So it's not like we're 100% in the market.
Yeah, no, it's really interesting. He's got some ammunition on the sidelines. So if we you mentioned energy, there's sort of a bit of concern, I guess, if you look at oil, that there's the US is just going to continue to be able to increasing supply. OPEC plus could come online and sort of saturate the market. Is this really, there's much concerned about, I guess, the WTI price? Is it more just that they're strong companies, they have strong balance sheets, and they should, they have a low cost of barrel?
Well, I think where people are probably missing the point is that, at least in our opinion, what we see in the companies, the Saudis and the US, I wouldn't say they're tapped out, but it's not like they can bring on another huge source to really increase those barrels a day. We've already gone, and probably 2 times almost, up until 13 million barrels a day. So I don't think we can get in a position where you can say, oh, they can bring on a whole lot more, because I just don't think they can. And I think so many countries today still run off, fossil fuels. So it's not that I'm not a conservationist, because I have property in Wyoming. I'm all for that. Okay, I just don't think we're at a spot now that you can flip that switch and make it work. And it's a long-term situation, and they tried to make it a short-term situation, which is not going to work, at least in our opinion.
Yeah, makes sense. So if we were to be very unfair on you and say, where do you think the markets, or where do you think the economy will be in start of 2025? What would you say?
Well, Anthony, I have to be honest with you, I have no idea. I've been around a long time, and I could tell you what I think, but I'd probably be wrong. The way we have to do things is we manage for the next 3 to 6 months, because we like to buy what we can see now, see what we know will work. Okay, I know what I can make on a 1-year Treasury right now. I know what I can make a certain amount of money, say 5%. I know I can make that. Now, whether the economy turns and goes one way or another in a year, I don't know. If I had to guess, sometime after the election, maybe it may take it that long, but somewhere along the way, and you have a bit of a weaker economy. I just see that in the cards. But if you don't get that, for us, that's okay, because we're still just going to be buying what we buy and looking at value the way we look at it, and not try to get caught up in guessing a macro move. Because when you get in and start investing like that, you're missing the point. It would be like buying a piece of real estate and wondering in Texas and wondering what's going on in North Dakota. What difference does it make? You see? And it's that sort of thing. And you have to look at investing that way. You have to buy what you know at the time and try to get away from what's going to happen in the economy, because it's going to come and go. And I won't be surprised. I'd give it a 50-50 chance that we have, at least 1 or 2 quarters that are slower, for sure.
Yeah, that makes sense, especially when we've seen such strong growth recently. You can't keep it up forever. You mentioned the election. Is that something that you take into account as well, or is that not as much a similar thing as you said? Is no point predicting?
Well, we had this big fiscal stimulus last year. I don't think people realize this, but 25% of what happened last year on the positive side, I'm talking about jobs and all sorts of things, was really the federal government, and spending systems. I mean, there's a lot of fiscal stuff. If they were to come back and do that this year, then you'd sort of have a remake of that and things would happen. Typically, they do loosen up, spend a lot of money during election years, the party in power. Whether they are able to do that this year, I don't know. They certainly did it last year, but you have to remember, when you have 34 trillion in debt and that we're going to have at least a $2 trillion deficit, it's really hard to run in and say, okay, I'm going to spend a whole lot more money now, because they're in a spot where if you were to have a recession and they had to come in with fiscal money at that point, then you'd have a 4 or 5 or $6 trillion deficit. And I think that's the risk you run if you start spending a whole lot more money here, which they're spending a lot of it anyway. But we're slowly but surely, Anthony, running into the wall on the treasuries. And people don't realize this, but the foreigners will quit buying our paper. They don't want that. They don't want what happened to them to happen to Russia when we took those funds over. And I don't think people realize this, but from 17 trillion to 34 trillion of debt that we put on, the foreigners didn't buy any of that. The U.S. bought it all. So, we're becoming like Japan, where we just buy our own debt.
Yeah, I'm sure like Japan can probably do it for a little bit as well, but it's not good for the economy. But
well, look at it.
Ted,
It just keeps them in recession forever. What have they had, 8 or 9 recessions? I mean, in a row, though. I'm talking about in a row. Well, that's not a good look for economically.
yeah, definitely. So, yep, Ted, thanks so much for your time today. Really
Yeah.
appreciate it. If anyone, so my last question is, what is one message you'd like people to take away from our conversation?
Well, I think individual investors, if you're highly invested in stocks today, and you're probably in the indexes or in some exchange traded funds, I would encourage you. You don't have to sell out of the market, but I would encourage you to take some of that off, okay, and just ice it down, because you can get, like I say, in a 90-day treasury, you can get 5 1/4, and there's nothing wrong with that, and that may be the best thing you can earn the next 6 or 9 months. But try to keep your head on straight and realize that at times in the market you need to have more money in it, and at times you need to have less. And you just look at Warren Buffett. They haven't been buying much at all. In fact, they sold some of their Apple, and they've got a hoard of cash right now. Take it from the best. They're not out there buying tons of things right now. So I'd give that same advice to the individual right now.
Great message. Yep. So, Ted, thanks so much for your time. Appreciate it. If anyone wanted to find out more about your work and what you do, where would the best places for that be?
Anthony, the best place is oxbowadvisors.com. If you come there, we've written a number of books. You'll see all our newsletters, all the interviews we do, a lot of things. We're really transparent. You'll see most of what we do. we don't hide a lot of things. I think a lot of firms like to say, hey, no, I don't want anybody to see this, but you know, we don't do that. You know, we just do what we do, and we're probably not going to change that much. But come to the website and you'll see anything there at oxbowadvisors.com you want to see.
Perfect. I'll put that on the description below. But thanks again for your time.
You bet, Anthony. Good to see you again.